Hey guys, my name is Ribu Ramprasad. I'm a mortgage agent and a multifamily investor. I've scaled my own multifamily investment portfolio and I'm helping others do the same. Now, in this video, we're going to break down different types of multifamily financing specific to Canadian context. First, I'm going to break down the types of financing available. Then we'll dive deep into a little bit of each types of financing. And third, we'll talk a little bit about why each type of financing exists. So there's three major ways that you can finance a multifamily apartment building. 1, bridge financing. 2, conventional bank financing. And 3, which is specific to Canada and an amazing product, CMHC-insured multifamily financing. Now, what's the difference between these three? Before I explain that, I need to explain a core concept, something called the debt coverage ratio. Now, the debt coverage ratio is a formula which essentially calculates whether an apartment building can support the loan you're going to take out on it. So when buying an apartment building, you're qualifying based on the building performance and not based on your own personal income. So first, we need to figure out what the net operating income of that building is, based on benchmarks determined by the lender. So this is the rent minus all of your expenses before your mortgage payment. So let's say you have a net operating income of 100K. That divided by your mortgage payment is your debt service coverage ratio. Typically, conventional banks need this ratio to be around 1.2 to 1.25, meaning that you need to be making 1.2 to 1.25 what your mortgage payment is going to be. Now, especially in markets like Ontario, this can get very challenging because the values are so high, yet the rents are so low compared to the value. What that means is typically, especially in Ontario, you need a large down payment in order to help get a loan that can support the income of that building. This has been cost prohibitive for a lot of investors, especially newer investors trying to scale their portfolio. So now that we understand that, I can go into the different types of financing. Conventional bank financing requires that 1.2 to 1.25 debt coverage ratio that I mentioned early on in the video. This is based off a 25 to 30-year amortization and conventional bank rates of, let's say, 5 to 6% today. CMHC financing is the other side of the spectrum, with really long amortizations up to 50 years and very low rates, 3.5 to 4% in some cases. Now, what that means is your monthly mortgage payment is going to be a lot lower for the same loan, which means you need less income to meet that debt coverage ratio requirement. Another benefit of CMHC financing is that your debt coverage ratio can be as low as 1.1 in some cases, depending on the product that you take, especially something called MLI Select. So if there's CMHC and there's conventional, why would I need a bridge loan? Well, in a lot of cases, especially if you're going after a value-add project, you would need a bridge loan because the property may not qualify for either one of those products. So what does a bridge loan look like? You need 25% down. It usually comes with a higher interest rate, but in most cases, there's no debt coverage ratio requirement. So you might be paying higher interest, but now you put 25 instead of 35, 40% that may be required in order to debt service this property for a conventional CMHC loan. The benefit also is now once you've completed your value add project, so whether that be renovations, unit turnover, whatever, you can refinance your asset at the end of your project to conventional or CMHC at the higher valuation in order to recoup some of the investment capital you initially put in. There is a caveat with this. Obviously, being a higher interest loan, there is a high likelihood that you're probably going to be negative cash flow. So a lot of the lenders, especially the better price lenders, will look to see that you have an interest reserve. They're looking for this interest reserve to ensure that you have the capacity to soak up that negative cash flow for the duration of the project. So let's pull it all together. How would I buy a multifamily asset? Well, first, I need to decide whether this is a buy and hold turnkey property or a value add play. If it is a buy and hold turnkey property, I'm probably going to buy with conventional financing or CMHC financing. There's pros and cons to both, and we can chat more about what that means in future videos. Now, if you're doing a value add play, that's where bridge loans come into play, and it is a great tool to maximize that return on capital for the duration of your project. Okay, so that was a lot of information and very, very high level. In future videos, I'll be digging into the details of each one of these types of financing. What are the pros and cons of each type of financing? And we'll go through some specific case studies of when each type of financing will be used. If you're looking to scale your multifamily portfolio and looking to get more details and insights into how to execute this on a detailed level, hit that subscribe button because we'll be getting real nerdy on here.